with that, we move on to our first panel discussion of day two, which is setting ultra rich investors' expectation. On this, we are going to be joined by a very eminent list of panelists. But first up, let me take this opportunity to introduce to the audience our moderator for the day, Mr. Viral Berawala, Director of Buoyant Capital. With over 19 years of work experience, a PGPX from IIM Ahmedabad, and a chartered accountant, Mr. Viral has worked as the CIO at SL Mutual Fund and Reliance Nippon Life Insurance, where he was responsible for AUM of over rupees 18,000 crore across asset classes. Prior to that, he was with Reliance Mutual Funds, managing various funds as assistant PM. Mr. Viral is also an avid reader. Thank you so much for joining us this morning.
Thank you for having me.
And moving on, let me quickly take this opportunity to also introduce to you our panelists for the day. First up, Mr. Ashish Shanker, Deputy Managing Director, Motilal Oswal Private Wealth. Mr. Ashish is the Deputy Managing Director at Motilal Oswal Private Health Management, encompassing family office mandates, product and research, financial planning, and investment strategy. He has been associated with Motilal for over 8 years and is instrumental in evolving the proprietary 4C framework for selecting equity and fixed income managers in India. A very good morning to you, Mr. Ashish, and thank you so much for joining us today.
Good morning, Shruti. Thanks for having me here.
Our pleasure, sir. And our next panelist for the day, Mr. Feroze Azeez, who is the Deputy CEO of Anand Rathi Wealth Services. Mr. Feroze is known for his radical methods of wealth management and financial engineering in the industry. A brilliant thinker, the structured product industry has seen many of his product innovations succeed over a period of time. Mr. Feroze is a mechanical engineer and also holds a postgraduate diploma in management with majors in derivatives and finance. A very good morning to you, Mr. Feroze, and thank you so much for joining us. Right. And up next, our third panelist, Mr. Atul Singh, who is the founder and chief executive officer of Validus Wealth. Mr. Atul, like I mentioned, is the founder and chief executive officer at Validus Wealth India. He is a veteran in the wealth management industry. Mr. Atul holds an MBA from IIM Bangalore with a director's medal and a degree in electrical engineering from the Birla Institute of Technology, Ranchi, with a presidential gold medal. It's an absolute honor having you here, sir, with us. Thank you so much for joining us. And on that note, I think it's time for me to hand over to our moderator. It's all yours, Mr. Viral.
Yeah, thank you, Shruti. Thanks for the introductions. So maybe just to set the context, I'll on how do you manage return expectations for Ultra HNIs? We'll start maybe with the definition of Ultra HNIs, and different organizations measure Ultra HNIs differently. But one I found relevant was by Knight Frank, and that is that $3 million is the threshold for definition of a Ultra HNI. So let's kickstart with Ashish, and the question or the point that I had was Ultra HNI might have gained wealth differently. Somebody might have come to wealth through a startup. And for him a 20% CAGR would be par for course. Somebody might have been a professional all his life and accumulated wealth differently. So how do you deal with these different cross sections of Ultra HNIs and the return expectations? How do you train the team?
Yeah, thanks, Viral. See, one has to understand that by definition, an Ultra HNI himself is a very successful individual or a very, very successful family. So they have created the wealth. So I think first, the wealth manager should be no illusion that he's trying to create wealth for them. In fact, in most cases, I find that once somebody has encashed out of their business, for their personal portfolios, they become extremely conservative. So I think the first step is to try and understand what does the Ultra HNI or the family want out of their investment monies, right? Now, in most cases, like I said, they want to preserve the wealth that they've created over many years. But yes, there are different types of Ultra HNIs like you alluded to. So it could be an old family office. So this could be old wealth that the family has created through generations of their business. It could be new wealth wherein a startup founder has cashed out and suddenly created a large pot of wealth. Or at times we also come across CEOs or CXOs of very, very large corporations who created wealth through their ESOPs, right? Now, it is important to understand the nuances and preferences of each type of Ultra HNI. For example, if I take the example of a startup founder, yes, he wants his money to compound at a certain rate, but at the same time, these people also want to keep investing in the startup ecosystem because they've found success through the startup ecosystem, and they believe that it is their duty to also promote and give back to the startup ecosystem which made them so successful. Similarly, a successful CEO or successful CXO probably wants to keep aside some corpus for the family, which is normally conservative, and return expectations are also set accordingly. But again, there is a side to this person who wants to invest in listed businesses or startups again. So I think it's important to understand the preferences of each ultra high net worth family. Then, of course, normally when you first meet this family and they have encashed out of a business, tax planning becomes the first point of call. So it is important that a wealth manager who's going to meet an HNI who's created wealth out of a stake sale, or it could also be out of selling some properties. The first port of call is always, how do you manage your taxes efficiently? So knowledge of taxation, or for example, partnering with firms who are experts at tax becomes all the more important. Lastly, but not the least, Viral, I would also say that in many cases, see, old family offices or who've been managing their money for generations normally are very organized. I mean, they've got their trusts in place, they've got their charities in place. However, when somebody comes into monies uh, in a big way suddenly, what happens is that these are also points of discussion. What would that person or the family like to do for society? Would they like to give back? How do they want to fence the wealth? How do they want to ensure that this wealth passes on to the next generations in a smooth manner? And lastly, but not the least, we found that most founders or people who are extremely successful also are attached to a certain value system. So they also want to ensure that their wealth, which is passed on to the next generations, is used in a particular fashion. So you sit with them and work with them through the governance of the corpus. How do you ring fence it? And of course, like I said, tax planning is normally the first port of call. Like I said, in most cases, we've seen that once somebody cashes out of their businesses, they become conservative with their own pot of wealth, with the nuances of different successful entrepreneurs who come from different backgrounds.
Uh-huh. Great. So, Feroz, maybe, just carrying on from this point. So, once you have decided what the tax planning is and what they want to do with the wealth for the long term, how do you help them make an investment decision? I mean, is the recommendation process similar for a UHNI versus other investors? For a lot of other investors, it starts as a goal-based investing. But since these people are so rich, I mean, most of their life goals are anyway achieved. So, how do you help make the investment decision?
Viral, I think when it comes to Ultra HNI, we personally believe that we should not just focus on what they want to do, right? We as advisors, our role is to guide them in the direction of a mid path. Like Ashish rightly said, most people who've got money lately would want to be very conservative with their monies which they've got by a stake sale, by a large property sale. Trying to make sure that they go on the path of not extremes is what I think is a core job of an advisor. Uh, Especially in the situation where over the last couple of decades, India has enjoyed a high interest rate. So savers, ultra HNIs, HNIs have not been compelled to take the risk to grow their capital. So I think bringing them to the path of neither extremes is the first job of an advisor when it comes to ultra HNI. Second, of course, it's very different managing ultra HNI money. To my mind, Ultra HNI money, one thing which is key differentiation is that they have the tendency of being transactional in nature. Moving them from transactional to strategy. Strategy, by which I mean a full portfolio of different constituents having different roles to play to, to deliver a specific outcome as a group of products and a portfolio. I think that's the biggest challenge. Ultra HNIs are very transactional nature. Let me invest in this startup. Let me invest in this stock. Let me see if I can buy some unlisted stock. So moving them from transactional to constituents of a portfolio which behave together in a certain fashion, I think that's the key role of an advisor there. And thirdly, I think how much ever the Ultra HNI believes that his estate planning is done well, to my mind, there is a lot in the area of estate planning, not just tax planning of the transaction of he having got the money, but tax planning from a recurring standpoint. I think that's a very important thing. And trying to formulate a very, very good transition plan, I think is the role of an advisor. And I think it's a very big myth in the Ultra HNI segment that they understand risks. Or anybody for that matter. Risks in our industry have not been numerically measured. And I think 5-6 risks, if they can be numerically measured for the Ultra HNI, and then you would have situations when stuff like this happens, the March and April of 2020, they've already envisaged that this can happen and what will happen to their money. Giving them simulations of what can happen in different situations is something which we like to do, so that it's not a surprise when the wolves are knocking on the door.
Yeah. Thanks, Feroze, for this. I will probably come back again on risk. But in the meantime, Atul, if you could just carry this conversation forward on both the speakers mentioned that apart from returns, there are other expectations that ultra rich people have. So in the wider areas, they did mention of estate planning or taxation, maybe even cross-border taxation. So how does one create a USP and service capabilities in these areas?
Yeah, thanks, Viral. No, so absolutely. I think the for Ultra HNI, if you think who is the core audience there, it's business owners typically today. And in India, almost 90% of the businesses in the next 10 years will go through succession, right? Succession of businesses, but also succession of wealth. And based on the data points from developed world, we have seen that these successions have been the biggest destroyers of wealth, right? I mean, the businesses get destroyed as well as the wealth if they are not planned very well in advance. When everything is okay. See, when you get into an issue, and if something happens to the patriarch, and then it's too late, right? Or there is fight in the family, etc. So you got to do that when everything is okay, and when there is almost you feel that there is no need for that conversation. You got to do it then, right? A very structured process to transfer the wealth beyond tax planning, right? So tax planning is one thing, but just this succession needs to be focused on, right? So and there are best practices all around, but engaging them when everything is fine with the family is one of the core things that today expectation of ultra rich families is, and or not expectation but delivery or deliverable of a seasoned private banker is serving ultra rich families. I mean, we have this example of Hinduja family, which always were the beacon of solidarity and camaraderie, now fighting for the stakes in different companies all around one single piece of paper which somebody wrote somewhere and signed, which said that every company has equal stake by all the brothers, but there was no formal sort of detailing of that or legal agreements, etc. And then it will lead to tremendous wealth destruction, right? So that's one. The second is where I have seen, which similar to what Feroze mentioned, these ultra rich families, and I'm talking about slightly older ones, not the ones that have just gotten into money, but somebody who has created wealth through business accruals over last 15-20 years. They have not looked at investments in a very systematic manner. So they have too many demat accounts, they have too many They bought too many products on a very transactional basis. There are lots of family members who are actually investing money. So there is no systematic, what I call aggregation of risk, right? And unless you really aggregate risk at one place, you cannot even begin to manage it. Managing returns or aggregation of returns is no meaning by itself, because return is an outcome of what risk you want to take, right? I mean, you want to dial down and dial up risk. You really need to get it all on one single piece of paper, right? So there is consolidation of assets. Then after consolidation in a systematic manner, layering in advice, maybe layering in governance on top, how to take big decisions, and then how to take small decisions in context of what the objective of the families are, etc., is another big what you call area that families, large families, diverse families require help, and again a big deliverable for a serious private bankers serving those families, right? And a lot of technology has to come in, but a lot of it is having the right dialogue with the family. Third is where if you think about sustaining wealth for multiple generations, you can't be in a single market, single currency. So the need for global diversifying assets is not only important, it's actually mandatory, right? So and it's not just about buying Apple and Google and putting $20,000 or $10,000 here. It's about actually systematically building robust, sustainable portfolios that are well diversified across currencies and are more importantly in hard currency, right, which have more stability as you go through longer periods in time, right? So there is a lot of investing work, but then there is also structuring work, right? Because it has to be structured well, but then beyond that, it has to be invested well as well. And like I said, it's not just about being excited about Amazon and Apple and Google. You could do that if you had retail money thrown at them, but systematic portfolio investing. I mean, we talk a lot about market neutral investing. Ultra high net worth families around the world have gravitated towards market neutral investing, right? I mean, they don't want to go through ups and downs of, yes, some part of the portfolio will be aligned to equity markets and bond markets, but a large part of 55% of the portfolios globally have gotten aligned to now market neutral investing, that irrespective of how the market moves, I have a target return, 6%, 7%. By the way, that return expectation is not very outrageous. I mean, it's a realistic expectation, but I want that with certain level of stability, and there is a way to achieve that. So thinking about that actively, again in terms of structure, but also in terms of investment options, so that you actually can take bigger bets. In fact, with a lot of our clients, ultra rich families, I mean, we are actually asking a question that which is combining this with the previous point, that how do we really think about setting up a global family office, right? Because why should your family office be local? I mean, we all are building our businesses in India. We live in India and we like it. I mean, our families are here. But as an investor, you do have a choice to behave like a global investor, right? And, on the surface, it looks, well, $250,000 limit, etc. But, when you really, in the whole space of FEMA, I mean, there is reasonably wide ranging options and flexibilities given to families today. Was not there before, but today, to really think global and build their family offices globally. So I think those are the top three non-investments or non-traditional investments. Let me tell you which stock to buy and which mutual fund to buy type advice. Again, structured transfer of wealth to the next generation, setting up a reasonably robust family office structure, whether you help them do it themselves or you do it for them, which aggregates risk and overlays advice based on that. And third is global diversification. I mean, there are things like advice on their business, strategic advice of buying, selling, raising money, etc. Maybe philanthropy, but those are all, I would say right now, ancillary to a core private banker. There are specialized firms there that would really focus on, but from a core private banker's perspective, the top three that I illuminated are the conversations we are having every day with families.
Sure. So all-weather portfolio seems to be the way to go, right? A bunch of uncorrelated or maybe even negatively correlated asset classes looks like the way to go. So maybe Ashish, sorry?
In India and abroad. I mean, globally,
yeah,
uncorrelated asset classes.
Sure. And so Ashish, just taking on from there, right? How do you educate the investor? I mean, what I've heard from all the three of you, it's like people get too conservative, or they don't understand it well. So how does the process of education of the investor work? And big money, so maybe even big egos. So how do you work with that?
So that's a journey, Viral. And to be honest, that's the most challenging part of the role of a wealth manager. See, what happens is, by definition, an Ultra HNI is extremely successful. And, these are people who are also very opinionated. And, for the right reasons, they think they know everything. Uh, and if you're successful in a particular field in business or life, you tend to correlate that to other fields as well, right? I think a large part of the wealth manager's job is to educate his customers on setting reasonable expectations, on the behavioral aspects of investing. I mean, we always say that there is an 80% rule in every business, and for me, the 80% rule in investing is really behavioral finance, right? It's can you be equanimous through the vagaries of the markets and different asset classes? Now, this is easier said than done, Kiran, because what happens is, in our industry, especially in India, we have our industry is still very nascent and young, right? Most successful wealth managers have probably spent little over a decade and a half in what they are doing, right? And they're probably in their early 40s or maybe late 40s. So in most cases, a very young relationship manager is going and advising uh, Ultra HNI. So obviously there is a little bit of skepticism which sets in when an Ultra HNI meets a wealth manager, because he or she feels that probably this come to sell me products. So I think it's important that for an Ultra HNI family, that especially an organization like what all of us are representing here, has a team which interacts with the client. So it could be right from the CEO or maybe a CIO, and the wealth manager, who's continuously communicating with the family, right? And educating the clients about the vagaries of the market, the experiences that you've personally had, or let's say, someone who's older and mature has had and then of course you can show a lot of data points and you can show a lot of analytics. But I am of the firm belief that unless once somebody crosses that path, right, he or she will not feel know how it feels, right? Like they say that in theory and practice is the same, but in practice it is different, right? So I always, when you onboard a Ultra HNI, the educating part and understanding the risk preferences of the family takes time. So I may, let's say, sit with an Ultra HNI a few times, speak to him, speak to his family members, try and understand their temperament, try and understand what investments they've done in the past, how they've behaved, so on and so forth, and then make an investment plan which I think suits them, right? But I think the first crash which happens is really the asset test, right? As they say, everybody is a long-term investor till the next bear market crash. So once you encounter a crash, right, you really know the behavior of the family. I mean, did you take out your investments at that point in time? Did you make changes? How often were you calling your wealth manager? How often did you need updates? Right? So risk temperament is something that you get to know only over a period of time. Now, all of us are used to this word risk profile. I mean, you can profile the customer how much ever you want on day one, but the risk temperament is known only over a period of time. So there is no shortcut. You have to spend time with the family. So typically, all the Ultra HNIs that we work with, who've been with us for 3, 5, 6 years, and they have seen 1 or 2 cycles with us, right? Are far more equanimous, right, when there is volatility in their portfolio. The other thing, Viral, is also, you know, how consistent you are in your communication, right? You keep changing your communication with markets or on the portfolio. So I'm sure all the firms do it, And it is normally the first thing that you do. You create something called an investment charter or an IPS, where you try to align the expectations and objectives of the family with certain long-term goals. And the goals could be anything. I mean, for an Ultra HNI, the goals is normally not a wedding or a child's education, because they are, obviously have a very large network. It could be some lifestyle related commitments, or it could be that they want to buy a certain business at some point in time, an operating business, or they want to buy some unlisted company. So, or it could be charities. So the objectives could be very different for Ultra HNI. But I think it's very important to define those objectives, create investment buckets, educate them on what could be the risks while investing. I mean, you can show them, the last 30 years of behavior of different asset classes. You can show them, what works, what has not worked. But like they say, the rubber hits the road when you have a real crash like we've had in March, and you get to know the nuances of the family. So, for example, an Ultra HNI who's been with us for, let's say, 5 years, and he comes up and tells me that, I want to make this investment. I can straight away tell him this is not for you. Like a doctor. I mean, if you go to your family doctor and the one look at you, he will tell you that, hey, nothing's happened to you, just go home. It'll be fine. Right? So over time, you get to know the temperament, the preferences, the nuances. So your risk management really gets far better, as you spend time with the family. But the key, I think, is consistency. The consistency in communication also is very important for an Ultra HNI kind of family, which is more complex, many family members, to represent your organization as a team, where you don't have just one member, one person trying to communicate. And ensure that you keep setting expectations from time to time and adjusting it and communicating that regularly with different family members with examples. So and then, as I said, the proof is really when you hit a crisis situation, how all of you react during that time.
Just a quick follow-up on this. So these are all family decisions, not a single individual. Like you kept here saying the word family, family. So it's always across most of them. These are all family decisions.
See, in a lot of families, what happens is the family designates one or two people to take decisions on finances, right? And the family may also have an operating business at the same time, and a family office investment portfolio. So there may be designated members from the family to do specific roles. So on a regular basis, you're interacting with those family members. But I feel it is important, at least annually, right, to get the family together, of course, with the consent of the patriarch or matriarch in certain cases now, and ensure that all the family members are on board with whatever decisions are being taken. We normally insist on an annual kind of a meeting, and it's not just for Ultra HNI families. Just to deviate a bit, even for normal customers, it is the patriarch, or in a lot of cases there are so many successful women now who take their own decisions. But it's important at a particular frequency, annually or semi-annually, where you get the other family members and tell them, look, this is how your wealth is being managed. I think that just brings in greater participation and consensus. And it also helps transmission, because tomorrow, say if the main decision maker for some reason is incapacitated, the other people are not completely in the dark on what's happening to the investment portfolios. And sometimes, the Ultra HNI families, Viral, what happens is there are differences in thought process also across family members. So one of the family members is conservative, somebody is very aggressive, and you have to then start catering to those preferences as well. So that's why, often I say this, that for complex families, Ultra HNIs, it is always good as an organization or institution to have a team, so that they also get to talk with different parts of the organization. And but of course, the communication has to be homogeneous and consistent.
Sure. So, Feroze, just carrying on from what you were talking earlier about investors being very conservative, how did their behavior change? When markets traded sharply lower between March 20 and July 20. I mean, was there a flight sort of response where okay, I put in X amount of money in August or September, my portfolio is back to that, and I would rather withdraw rather than stay invested. So, did you see a massive change in risk appetite?
Not really amongst our clients, Viral. Of course, from a human tendency standpoint, there will be a huge change in risk appetite. Like Ashish said, everybody is a long-term investor until the bear markets arrive. So if you can tell them what is the worst which can happen before they invest, then that is when you would actually be checking risk appetite. A 10-question questionnaire in English rather than mathematics cannot help us understand the risk, or cannot help us understand the reaction when the risk happens. That's the point. So when you actually take his investments, create a portfolio, if you told him if the market is 30% down, if the alphas of mutual funds are -4%, what will your portfolio look like? Now, that's the courage the advisor needs to display, because the probability of getting him onboarded reduces sharply if you show him the worst situations. If you have spoken very, very positively and not shown him the downsides, then there is a risk of erratic behavior from the investor. Point one. Point two is, I think when these things happen is when the advisor's role is amplified. If the client is behaving erratic, you will have to show him data to make sure that he is not taking extreme steps. So I think we showed data of the last 10 falls in India. And we made a note, which is a simple communication, that all the 10 times, 3 years hence, the market was worse come worse, 70% higher than where it started falling from. Right? So that gives you confidence to stay invested as an investor. So those communication, sharp data-backed communication is the need of the hour. And one more thing which we have been practicing is showing worse situations. And that helps a person envisage and probably visualize the day, the 23rd March.
But also, would some of them now be more open to looking at structured products, having seen this sharp fall?
See, I think structured products, people will be open as long as somebody is ready to open the black box. A person needs to be able to open the black box, one. Second is, needs to be prepared to operate an NBFC as an asset management company. That's when structured products will become relevant in Indian portfolios. You need to be able to have an NBFC where you don't have the greed of making NIM by lending to real estate, lending to flamboyant sectors, right? As long as you can operate an NBFC with 80-90% of your money in treasury operations, right? Then structured products become more relevant. I think that's what is lacking. The transparency in terms of how the derivative components are being hedged is largely a black box. And the frontline private banker needs to up his learning process. And then that will be a reality in risk mitigation.
Got it. But there is still a chicken and egg, right? Because there is not a big enough market. There are not big as many manufacturers or providers of structured products. So how do you see that part of market evolving?
Yes, it's a chicken and egg. You're absolutely right. And I think if you wait till the pull arrives, may not be the right strategy. So Anand Rathi has been issuing structures for the last 9 years. I have not got ourselves rated, okay, because we don't believe in rating, because it's a catch-22. For the last 8-9 years, we've been very vocal that paying to get ourselves rated fundamentally doesn't gel. So we've not got them rated as long as I can operate my NBFC as a treasury largely. So to answer your pointed question, you can either wait till the pull arrives and some other firms creating that curiosity, or you can do it yourself. So we have taken the path of not wanting to wait it out, because that makes sense in clients' portfolio to a reasonable extent.
Sure. And Atul, we spoke of uncorrelated or negatively correlated asset classes, but just there is a tendency of people to want to time the market. And I was reading a morning star study where just because of ill-advised timing, investors have underperformed markets by 80 bips. So, do you ever face that the Ultra HNI comes to you and starts pushing for entry or exit, and how do you work in those situations?
No, so it is definitely. I mean, the study by Morningstar is definitely on point. There is big difference between investor returns and product returns. All the funds, all the PMSs show fantastic returns, but if you go and ask clients what is their delivered return, and the picture is not so rosy, and a lot of it goes to trying to time the market, jumping in and out of the market, and believing that you can time it, right? I mean, we all talk a lot about being the time in the market rather than timing the market, being the driver of returns. But you can't blame the investors, because, as we discussed, both Feroze and Ashish mentioned, and I was listening to the previous speaker from Nippon as well. Investing is as much about maths as it is about emotions, human emotions, right? And Morgan Housel, if any of our listeners has not read the book, I would recommend that. Morgan Housel has written extensively about in a book called Psychology of Money. And so there is this whole thesis of how investors behave, and their actions that are driven by many emotional challenges, like bank anchoring is a bias, or chasing momentum, etc. So all of those things collectively put together drive that difference. But one has to, as an advisor, we have to obviously understand the drivers and then try to manage it. Now, because you can't take human emotions out of the equation, right? So now, how do you really manage that, right? So for example, I mean, looking at the whole rear view based investing, right? I mean, looking at past returns for predicting future returns. I mean, we keep repeating it in every mutual fund document, etc. But unfortunately, how do people make decisions? I mean, they look at past performance, and they make. Now, every study that is done on that shows that there's probably only a 30% probability of a top quartile fund, which is there in the past for whatever time horizon, will be there in the future. But still, people make their decisions that way. So you can't get away. Now, the exercise that we have found successful, and in fact, before I come there, the other challenge that you have, Viral, in the industry is, we all talk about asset allocation, and asset allocation is the cornerstone of any financial advice. But my challenge is that you take any investor and you ask them, what is your asset allocation today? And they wouldn't be able to tell you, right? Because the world is about investing a lot in hybrid products, right? I mean, balanced funds. Now, they get classified as equity funds because of tax treatment. But is that your equity exposure? No. I mean, 65% is equity, 35% is debt. Similarly, if the PMS manager is sitting on cash call of 70%, the cash call of 30%, your equity exposure is only 70 and not 100. But so investors don't know what their asset allocation is, and consequently, they don't manage to an asset allocation. Right? This whole rhetoric, this whole discussion between the advisor and client, and I can challenge every advisor. Right? I mean, it's only limited to when you're onboarding the client and you have to mandatorily ask the risk profile of the client, and hence your asset allocation should be X and Y. But broadly, you just have no ability to really manage to an asset allocation, right? So I think to answer or to counter the emotional bias that will always be there is a more structured investment process with the client, which starts with trying to define an investment policy statement. I think Ashish mentioned investment policy statement, not necessarily at 50 crores level only, but even at 5 crores, right? Thinking about sources of risk. What are the 5 sources of risk? Let's articulate that. And what is the liquidity requirement? And then enumerate an asset allocation as well. That, look, all of this taken together, here is your asset allocation. And you got to really then have an ability to monitor how your asset allocation is shifting, so that you can actually take decisions based on that. Every decision, not in good times or bad times. In every time, the decision should be based on asset allocation, right? I mean, we harp a lot on March 23rd and try to hold the client on a certain asset allocation and say, hey, don't jump around and sell all equity and go in debt. But that should be just so ingrained in the investment process in good times as well, that bad times can be taken in stride. At our firm, I mean, one of our sort of key tenets of founding the business was that we wanted to put technology. So you cannot really achieve a true view of asset allocation without technology, right? Because like I said, lots of investing happens now in hybrid products, right? RMs, advisors don't have mental bandwidth to be able to really distill what your asset allocation is. And if you throw labor at it, it's always kind of chasing the tail, right? So, and today digital is probably the only answer when you really apply that on clients' portfolios. And clients have a crystal clear view of what their true asset allocation is, not the product-based asset allocation, but what their true asset allocation is, counting 65% of balanced funds and 35 in debt, so on and so forth, and what your true exposure is. That gives you some confidence to really start to imbibe the asset allocation-based discussion in a regular course of money management, right? So some gaps need to be filled by the industry, technology namely, and on that technology, the conversation that the RMs are going to have. I mean, I would love to have every RM in the country to have that asset allocation-led conversation every time they meet the client, but they just don't have the tools to do that, right? So that's probably the only way to counter human emotions, where you really put a rigid framework of having a lot of those discussions about the sources of risk and how we behave. And, it encapsulates everything. I mean, I think Feroze mentioned showing them scenarios, etc. All of that is part of that. And doing that upfront when you're not in the crisis, and putting the frame around that on driving your investment behavior, keep visiting that on a monthly basis, is probably the only way to really drive through some of these blips that you will face inevitably. Otherwise, I mean, you can keep telling them about how to behave in these tough situations, and client would always agree, and then they turn back if you have not really bound them in a certain framework for taking investment decisions. So that's one answer to really minimize the gap between what the investors eventually get and what the products tout to have delivered, because there is indeed a big divergence.
Any interest in really non-mainstream asset class like art that you see? Quickly, if you can spend a minute on that.
Yeah, I mean, see, I'm a big fan of sort of thinking about core asset classes, right? I mean, there is a lot of risk diversification that can be done with core mature asset classes, right? I said equity and debt are the core. There are some alternatives like REIT and gold that have become, you can use them as core. And then there is a whole host of techniques that you can really create to create uncorrelated market sort of asset classes, let's say global arbitrage or arbitrage funds like I said, gold, REIT. In Indian context, in outside India context, there are many other asset classes that are mature. Now, art, for example, is not a mature asset class, right? Because unless there is transparency in how you value the art, and there is a model that you can really use to drive some transparency, it cannot really become a mature investment asset class, right? There is a lot of discussion around, I mean, there was massive euphoria around Bitcoins and electronic currency as an asset class as well, but it's just not matured enough for bringing widespread money. Now, if you're a technology geek and if you want to experiment and put $10,000, $15,000, $20,000, go ahead, because that will immediately get you more interested in what's happening in the industry. So from a knowledge perspective, it will kind of open up your doors. But as a core investment class, no. Outside of gold, no real mature asset class in commodities also for private investors. For traders,
sorry, we need to stop now. Actually, so sorry to interrupt.
Sure.
So thanks everyone for your time and insight, and appreciate everyone's presence. Thank you.
Thanks, Viral. Thanks for hosting me.
Thank you.
Bye, Ashish, Atul.
Bye. Yeah, thank you.
Bye, Atul. Bye, Feroze.
Thank you. Thank you so much to our esteemed panelists for joining us today. Thank you so much to our moderator for a very wonderful session. I know that we wanted to keep things, very prim and proper, which is why we had to stick to the time limit. Thank you so much.